Hi, this is Andy Flipiak in Toronto for the week of October the 27th. I came across a very interesting chart that I've included with this video from Bloomberg that plots from 1926 to the present on a graph showing bond and stock market performance. Now, the upper right quadrant shows sort of the best performance. The lower left is the worst performance for bonds and stocks. And if you take a look, you can see 2022 is now the second worst year in the last 96 for combined bond and stock performance. And this is even worse than 2007 through 2009 period. So investors are really feeling it in those asset classes. Now, what I found very interesting was the two other categories. The worst performer was 1931, which was the bottoming of the stock market sell-off from 1929, where the Dow dropped 89% over that 3-year period. And at the time, 1931, there were sovereign debt defaults in Austria, etc. So it was a very bad year where markets were working off the excesses of the 1920s. As well, 1969 is on there. And the 1960s, with the U.S. policy of guns and butter, the Vietnam War, the social spending, 1968 is when the tie between gold and the U.S. dollar started to crack, and the London Gold Pool was formed in order to try to keep the peg between the U.S. dollar and gold at $35 an ounce. 2 years later, we saw the U.S. abandon the gold standard completely, and that started a whole new reset or economic era with currencies not backed by anything. Conversely, 1931, by 1934, FDR had revalued the U.S. dollar to gold, devaluing the U.S. dollar by 40% against gold, and actually confiscating U.S. citizens' gold at the time. So it's interesting that these 2 years just preceded major changes to the structure of the global economy and the dollar and gold's relationship in it. So unfortunately, these periods preceded a very tough market performance for investors. Like 1966 to 1984, the Dow Jones did virtually nothing while bond yields rose with the 1970s inflation. In the 1930s, the U.S. was desperate to try to get out of the Great Depression. And again, it was very difficult for investors until the World War started and sort of restructured the production machine. So this chart, while scary, also I think highlights what we might be seeing for the next few years as the world is forced to restructure all of the excesses that we have seen over the past decade or more with the quantitative easing, the amount of debt in relation to GDP, and now the inflation that has occurred from all the money printing that they did in order to reflate the economy over the last 10 years. Thanks for watching.